everybody. So what I want to do today, I try to do these webinars. I haven't done as many as these as I'd like to. I'm so busy. But today I want to do a little bit of trading. I'm going to show you the Atlas line as it appears on the charts. We'll look at a couple of markets, answer your questions. I want to teach you a little something about a method of breaking up the day for those of you who are new to trading or who already know this method. I'm going to bring a little bit more insight to it. If there's any trades that occur, we're going to look at them, manage them, take them. I'll answer your questions. So within the next hour or so, we're going to have a thanks, Ann. We're going to have a good show here. Okay. Also, I have a mentorship class starting. Those of you who are interested, those of you who are current clients as well, if you guys want to join in for the next 2 months, it includes all the programs, all the software. It's one all-inclusive package at a reduced rate. It's the group mentorship class starting next week, and I can email you all the details if you have any questions on it. Okay, so first, let me just take this off here. I'm going to add here the Atlas line here to the E-mini. The one thing that I like to use, and I think that everyone should be using as well, we have about 10 minutes or so until the Atlas line fires a trade, long or short. I'm not sure which way it's going to go, but we're going to see it live as it happens. But the one thing that every trader should use as far as an actual idea and method to trade the markets is looking at adding the ATR, the average true range, which I have right here. Usually I set it to a setting of 4, which tells me the last 4 bars. I also like to add the bar timer, because the bar timer allows me to say there's 5 minutes left, there's 4 minutes left, and a lot of the trades that I take are based on the closing of a candle. So I don't necessarily just jump in long or short. I wait for proof, and proof is very important because, as you know, the market could run up or run down seconds when there's a news event, but when that candle closes, it means something, it tells me something. So I always like to wait until a candle closes before dictating to go long or short, and I think that's a very important part of trading, as well as understanding the current conditions. Market's very volatile. This is 3 1/4 points. I always round down. And by the way, if anyone has any questions, you can go ahead and ask me during this training. You don't have to wait until the end, okay? You can go ahead and ask me as you see them, because I think it's important to see something and ask something as it's happening instead of later on after the fact, okay? So let's first take a look at this average true range of 3 1/4 points here. I always round down. Rounding down is very important. I always use this average true range to tell me the current conditions, what you can expect out of the market. And I think that a lot of traders, as the more traders I talk to, it seems that they always want to take the same profit or the same stop regardless of the current conditions. And I think that's a mistake. I really do think that you can't trade the same way if the market's slow as opposed to the market when it's fast. You have to adapt to it. And adapting, not just to trading, but anything in life, is very important. You have to adapt to the current conditions. So if I understand that this here is showing me 3 1/4 points, almost 3 1/2 points, you have to think about, if I have a 1-point stop, what's going to happen? You know, 1-point stop is going to knock me out just with the randomness of the market moving up or down. It's inevitable that the market's not just going to go straight down or straight up. It's going to move up and down like this. The key here is to know how much it's going to move and understand that should be my profit target, as well as should I have my stop smaller than what the current conditions entail. So if 3 1/4 points, or almost 3 1/2 points here, is what the market can do from wherever this candle closes, It could move up 3.5 points or down 3.5 points. Then I have to be very careful not to have a stop that's smaller than that. And so a lot of people tell me, um, you have a large stop and it's hard to trade with large stops. But the key is not to get stopped out. The key is to use a combination of stops, as I teach, to protect you in case anything that comes your way could happen. So as an example, let's say that you have a stop initially that is a little bit larger than the current conditions today. It happens to be an extreme. It's 3.25 points. It's pretty big. If you have a stop that's smaller than that, you're going to inevitably see it maybe hit your stop. So you have to have it a little bit larger. But let's use something else to protect ourselves. I like to use a combination of stops. I like to use some type of time base. I also like to use some type of proof to get me out. So if the trade isn't going to work, right, let's say the trade's not going to work right off the bat, then what I want to do instead is see it, understand it. Too much time has gone by. There's proof that I shouldn't be in the trade because it's going against me. I'm immediately out of the trade. So you have to use a stop initially to protect yourself, but use something else, a much smaller stop, proof, or time to exit the trade. Okay, so that's important. The bar timer is important. Price action is important as well. So all of these things combined create a trading method or a trading idea. A lot of traders want to see something automated, and sometimes it's hard to do something automated because there's a lot of situations that could occur. There's news that could be thrown in. So I like to look at the market as it is. I like to be in the now. I want to see what's happening, and I don't like to overtrade. And a lot of traders look at the markets and say, I want to trade every single signal. That is a mistake. Only pick and choose the best trades, the best setups as they come your way. Because the more entries and the more that you trade, the bigger the risk. Always think that way. So I don't like to trade 24 hours a day. I look to trade when it's most active. Now, if you look at here, the market, you can see that at times it's slower, at times there's more action. And you have to say, is it really worth trading when the market is slow or when the market is too volatile? And I'm going to have to say it's not worth it. It's just too slow or it's just too volatile. So you don't have to trade all day long. As an example, I like to put here a line here at 1 point, which is 4 ticks on the E-mini S&P. This line right here on the ATR determines whether or not I should be trading. It's a risk factor. And as an example, whenever the market falls below 1 point, really what that means is that the last 20 minutes, remember I'm using a 5-minute chart, the last 20 minutes, the market is unable to trade more than 4 ticks or more than a point within the last 20 minutes on average. That's very difficult to trade, and usually when the market falls below a point, which trading on average 2 ticks or 3 ticks, you have this chop, channel, whipsaw. It's very common to see that. The same thing here, if you look at this here. This is a correlation of the market being too slow. Now this is in the middle of the night. I live in the Eastern Standard Time frame. I'm in Florida. So for me, I can't really be up and trading here at 1 o'clock in the morning. I have to be fresh for the next day. But this isn't something that I really want to take a look at. This, on the other hand, where the market's really volatile at 2 points, 3 points, this, and for my experience, is always better than trading when it's slow because the market doesn't go anywhere. It doesn't do anything. There's nobody trading, and there's more manipulation under this kind of a slow condition than when the market's more volatile. The other instance where I find where a lot of traders attempt to trade is during news events. We have to break this up. We're going to have a signal here on the, and I'll show you here also the euro. This is the euro currency as well. And so I'll show you a couple of signals on different markets using the Atlas line and using the methods that I trade. Let me just change this here. And okay, so there's a short on the euro. I'm sorry, a long on the euro, 27.31, a short on the E-mini 1954.50. Okay, those are the two signals. Let me just come here. And 1954.50.
Order pending.
Okay, market ran away from me a little bit here. I should have been quicker on the draw, but 1954.50 is the entry here to go short. I should have went in at market, but ran away from me. Did anybody get that 1954.50? Those of you who have the Atlas line? All right, Andy. So the signals that the Atlas line produces are the same. I lost out on this trade here. Maybe we'll get a pullback or a strength trade here. Okay, so unfortunately I couldn't get this short here at 1954.50, but that was a signal to go short. The long on the euro here is to go long. Excellent, Andy. All right, good job. All right, we'll get some more signals, guys. Not to worry. We'll take a look at. I'll bring up the Dow as well. Nasdaq. Yeah, bring up the Nasdaq here. Okay. Short as well on the Nasdaq. Okay, we'll get a pullback or a strength trade here within the hour. We'll keep an eye on it. We'll take something. This is an auto signal. It is. So it provides you signals automatically. Mike, the crude oil, I'm not a big crude oil gold fan, but I'll bring up the crude oil. This is not a problem. I have the crude oil here, right here. And I'll bring up the Atlas line here for the crude oil. Short on the crude oil, 86.63. This is for Mike. Okay, so let's first think about here. I know I didn't get this trade. That's unfortunate. I should have went in at market. As when I do these webinars, usually I'm faster getting in because I'm not, conducting here a class. The reason why I like the bar timer is because the bar timer tells me how many seconds or minutes are left. And so I always use that to say there's 10 seconds left. Let me get ready to initiate a trade. So I should have done that a little bit faster today. But let's say that this 1954.50 trade was entered short. How do you manage that? I think that's very important. So let's say that you enter short 1954.50. First thing is you have to have a stop. The stop is a protective measure. I call it a catastrophic stop, and it needs to be not equal to, but at least the ATR or larger. Because remember, I'm concerned that the market can move from this closing price, which is from the Atlas line entry, this distance. So if I have a stop, a catastrophic stop as I call it, smaller or equal to that value, just the market moving up and down, it's not, in this case it went straight down, but it could very well have done this, right? So I can't have a stop that's smaller than that. The other thing that I want to think about is, what is my target? The target is going to be 1 times the ATR. Now, I do trail a stop and trail a target, not often, but I do like to do that under circumstances where the market's trending very hard. I mean, at 3.25 points or 3 points, I think I'm very happy with that kind of a profit. I'm not looking to trail more than that. I'll take my money and run any day. And I can show you how I trail a stop as well. But let's say that you enter here at 1954.50 and the market doesn't do anything or doesn't go in your favor or just starts to whipsaw. A time element to hold this trade is very important because the longer you stay in a trade that's not going in your favor, the worse off you are. Because you entered for a reason. It's not to say that an hour, 2 hours later, it's going to happen. It's 2 hours later. The trade is already gone. It's done with. You're not now hoping that it's going to move in your favor. So remember, limit the amount of time that you're in the market. Probably from the videos, you know that I like to hold trades no longer than four or five candles after entry. And it's relative. So if you're looking at a 5-minute chart, it would be 20, 25 minutes max. If you're looking at a 15-minute chart, it's about an hour. Obviously, the target is bigger, the stops are bigger on that larger time frame, but limit the amount of candles that you hold a trade, because in holding a trade for 2 hours, 3 hours all day long, it has nothing to do with the reason you entered early in the morning. So after 4 or 5 candles, wherever it is, could be a small win, a small loser, a break-even trade, almost the target, I'm just going to cut it loose and get out of the trade. I think that's very important. Proof. What kind of proof do I use to get out of the trade? Well, in this specific method, I teach a few, but in this specific method, the proof is going to be if there's a closing price on the opposite side of the Atlas line. Now, this is a pretty big run. It's pretty far, but technically, you want to get out when there's a closing price on the opposite side of the Atlas line, because now the market may be changing, maybe reversing, and maybe giving you a long signal instead. So let me see if I can show you. I'll go to yesterday here. So yesterday, this long signal here in the afternoon to go long at 1933. So this is the entry right here. This is a lot closer to the Atlas line to go long. So a prove it stop is going to be when there's a closing price on the opposite side. So this is preferable because you're entering closer as it begins to take off or at the start of this upward move. So there's proof, there's time, and there's a catastrophic stop that you have to have. Now we may be getting a pullback trade to go short again, or it may rally and provide a long opportunity. I don't know, but we're going to see the signals automatically appear on the chart with the software, the Atlas line software. Okay. You know, Roberto, I don't have a regular trading room as far as every day, you know, traders joining me and trading live. I don't do that. There's a few reasons. The first thing is that if you always follow someone in a trading room, you're always going to be committed to following somebody else. You're not going to be able to do this on your own. So with everything that I do, whether it be the power price action, the Atlas line, the trade scalper, I make sure that we have a live session. I record the live session. I send you the live session, and I'm available for questions and answers at any time. I know some of you here in the room have been with me for a few years now, and I get questions from you all the time. Say, hey, how about this? How about that? And I always answer. You have to do this on your own. If you're always following somebody, you're going to be stuck following somebody. You're not going to be able to do this on your own. And traders need to be independent. That's why we do this. We're not, you know, we don't go to work every day from 9 to 5. We don't have a boss. We want to be independent. So in order to be that way, you have to practice. You have to know what you're doing, and you just can't depend on somebody. You have to be able to understand, yes, this is a short, this is how I manage it, this is my target, this is my stop, and it has to be clear. It has to be very objective. Bar timer stalls. I'm going to send you something here. Hold on a second. Let me just check here with my tech guy here. Hey, Chad, can you send me something on that bar timer that stalls so I can put it in the room? Okay. The NinjaTrader bar timer stalls, it has to be, it's usually based off of a data, and I did some research on it. Common question, Kevin. because my bar timer stalls. I got in contact with NinjaTrader. I have, and I'm affiliated with them as far as a partner, and I asked them, what's the story with this? Everybody asks me. It has to do with data. Data has to update in order for the bar timer to work. So I did do some research. I'm going to post it here in the room, and you can read up on it. Okay. Ron, absolutely. I always do, right? I make this available to everybody. Stefan, the Atlas line is, as you see it here, this line. It's not based off of any type of indicator like moving averages. There's nothing attached to it that needs to be optimized. It's closely aligned to support and resistance, if anything. And if you remember from high school, tangent and cotangent of an angle, the calculation is based off of that. So it's a proprietary software, Stefan. It provides signals to go long, short. It provides strength trades. I'll show you here. It provides strength trades, pullback trades, bounce trades. I have set to false because it provides a lot of signals, and so I don't want to clutter up my chart. It has a filter, whether you want to use the average true range to filter out when the market's slower. You don't want to see any signals. And so the Atlas line does a lot. But primarily the focus is, if this is below, think about short trades, whether it be scalping, whether it be holding it for a longer term. If the price is trading below the Atlas line, you're going to be more focused on short trades. And if it happens to cross, you're going to be focusing more on long trades if price is trading above the Atlas line. So it's a tool. It gives you entries. It provides entries for pullbacks and strength trades. All right, Stefan? The Russell, I'm not a big Russell fan. The Russell is a dangerous market, and there's a couple of traders out in California that I work with, Frank and Robert, I think his name is, who are big into Russell. And it's a market that can cut your head off. You got to be careful with the Russell. The E-mini, I think, is a little bit more tame. Hey, thanks, Nate. Appreciate that. All right. You can enter on retracements, but the retracements, Harinder, great question. The retracements have to be done right. So I'm not sure how you consider a retracement, okay? But retracements are done with a pattern. So you have to first understand, what is a retracement? Well, how can I understand what a retracement is? Everybody has a different take on a retracement. Let me tell you how I look at a retracement. A retracement has to be, first, understand what direction we're in. So everybody, I think, could agree that the market is going down, price is trading below the Atlas line, and so it's a downward trend, downward market, right? So that's the first step. Second step is, if the market's going to retrace, how do I understand or call it? When can I call it a retracement? I like to use the pattern, which is 2 or more consecutive bars that are retracing. So now we have to say, what does that mean? Well, in layman's terms, it happens to be 2 or more green bars, because since price is going down, 2 or more green bars. It could be 3 or 4 or 5, but 2 or more green bars tell me that the market's retracing. I just need 2. 1 could be a little bit premature, so we just have 1. So in this case here, I'm looking for 2 or more higher closed than opens candles consecutively. They have to be consecutive for me to say I understand that there's a retracement. Now the opposite, or the flip side, Harinder, is going to be, what if price is moving up? What would you say a retracement is to here? Well, it's the opposite. It would be 2 or more consecutive red bars that are retracing, and they're coming back to the Atlas line. And in this case, this tells me that I should look for an opportunity to go long or short when proof comes my way. So the first thing to do is understand, do we have a retracement? Do we have two or more candles pulling back or retracing? After we see two or more candles retracing, I'm looking for the proof to continue this long or to continue this short. The first candle that closes back red, which is, let's say for example, like this. You have two or more, let's say you have three here bars that are green retracing back. The first candle that is red, it doesn't matter if it makes higher highs, it doesn't matter if it makes lower low, it doesn't matter. If it's engulfing candle, doesn't matter. The first red candle tells me that this pattern is complete. There is my proof that the market retraced two or more candles pulling back, followed by the first candle that is now returning back in that same direction. At the close of that candle, I'm short. The software tells you pull back, short, go short. And that's how I interpret a pullback. So it has to be clear, objective, based on price action, a pattern, without just looking at it and saying, I think it's pulling back. I don't know, could be. Now it looks like this may be a strength trade here. And so you're going to see in about 2 minutes these S's appear which say strength trade. Time to go short. All right. Harinder, any questions on that? Yes, it does, John. It provides the signals are provided automatically. So you're going to see in about 2 minutes if this candle stays where it is, it's going to be a strength trade, and it's going to plot S's. If this candle closes as a doji or green, it violates that signal, and it's not going to be considered a strength trade. Okay, so it could go either way right now. Okay, you got it, John. Yeah, you did, Jay, right? Absolutely, Jay. You got it, Harinder. Hey, Nate, do you see anything here setting up? West Coast Nate, there in Oregon. There's a setup here that you learned that's starting to set up. You see it? Let me know if you see it. To prepare yourself, there may be another trade here, long or short coming up. It's all based off of price action. Okay, so how do we trail stops? So while we were looking at this market, yep, you got it, Andy. Blueprint, absolutely, absolutely. Sure, John. I think there are a couple here in the room. This webinar here, I'm not going to disclose everything that I teach here, but there are a couple of students here in the room that are power price action students, that are mentorship students, that always like to follow me and see if I have anything new to offer. And I never have any problem with anyone, chiming in and giving your perspective on what I teach, how I teach, if they like the program. And I try to ask for some videos, testimonial videos. Not everybody's comfortable doing that. I have a few on the website. You can take a look at what they have to say. And those are all real people. They're not fake people. They're all real people. I think West Coast Nate, if he's still here, let's take a look here what he said here, if I can find. Okay. So now I explained to you that 2 or more consecutive bars tell me that the market's pulling back. So as a trader, primarily focused on price action, not on all those indicators that are available to you, I can understand, and understanding what you're seeing needs to be clear that there's 2 or more bars pulling back. Classic pullback. After this candle closes, I'm then going to look for the first candle that closes red, which tells me we're now continuing back down. We've had a pullback and now we're just following it and coming back down. I still have to use stops. I still have to have an exact target. All those things are true, but you have to be able to see it as it's happening and not just, you know, pulling, shooting from the hip. No, the outside is software, Kevin, and it's a proprietary software. No worries. No worries, Nate. So the first thing here is understanding there's a pullback followed by a continuation moving down. The software is going to plot a pullback, and that's all if it happens. And it may not happen, and that's why we have to wait for confirmation. Let's talk a little bit about trailing stops here, because I want to also not just look for opportunities, but also see if you can learn something out of this this morning's webinar. A trailing stop, how most traders trail a stop is, let's say that you enter, we'll use some whole numbers here. Let's say that you enter at 1955, right? And you enter at 1955, and the goal is to go down, right? And as soon as the market makes a point or 2 points, right? What do? You have, let's say you have your stop up here. And so what most traders do is they put their stop right at where they entered because they don't want to lose any money. Now on paper, in theory, nobody wants to lose any money. But there's a different aspect of all of this. If you place your stop, if you move your stop right to entry, you have to see whether or not the market has moved more than this distance. Because if the ATR, the average true range, is telling me that the range of these candles are 4 points or 3 points, this is pretty volatile, are 4 points or 3 points, then it's likely that the market could go up or down 4 points, or whatever the ATR happens to be, 3 points or 2 points. So if you place your stop within this range here, and it's probably happened to all of us, where you put your stop too close and just normal market movement up and down, there's going to be you're going to get out of this market prematurely. So I understand that nobody wants to lose money, and I understand that you have to put your stop where at entry, so you don't lose any money. I understand all of that, but I'm going to change this around. I'm going to change the way that people or traders want to trail a stop, so it makes a little bit more sense than just the market moves just a little bit and right away you want to protect yourself, but you may be protecting yourself as the market whipsaws, gets you out, and only to see it continue further down. Okay, so the way that I like to trail a stop is going to be by first entering with multiple positions, and we'll just call it two contracts. So 2 contracts, we'll say short at 1955, right? 1955. And going short at 1955, I look at the average true range and I say, well, it's currently trading at 3 3/4 of a point, so I can expect the market to go down 3 3/4 of a point, which is 15 ticks, I believe. So I can expect the market to go 15 ticks. You have your catastrophic stop up here, just in case, just in case. Now, once the market makes this target, it's moved this distance, right? 15 ticks here would be 150, let's say, here if my math is right. 51/4, I believe it is. Once it's moved 3 3/4 of a point, now you have a break even, a true break even trade. So when you think about trailing a target or trailing a stop, start off with multiples of 2. So 2 contracts, right? Once it makes the profit target 1 times the ATR, exit half of your position. So once it makes 1 times the ATR, exit half of your position. Okay, so officially, 1 contract at 3 3/4 of a point. What's left? Well, you have 1 contract left, or the remainder half, which tells me that if this market completely fails and just goes straight against me, I have nothing to lose. I officially can claim this as a $0 trade. So 1 times the ATR, take half of your position off. The remainder, let's see it grow and go 2 times the ATR. The stop that you have here, initially placed, you will now move. Now is the time to move your stop, but you're not going to place this stop here where you entered. Again, because this is 3 3/4 of a point, it's a possibility that it could move 3 3/4 of a point back up and stop you out on that remaining contract. I'm willing to give back everything, and I'm willing to do that because now I'm going to place that remainder contract, the stop, equal to the profit I just made. That means that if I made 3 3/4 of a point on 1 contract, and for whatever reason the market's not ready to trail or to continue on in this trend, and it happens to climb and stops me out 3 3/4 of a point with my other contract, this becomes $0. And that's okay, because even though I didn't make any money on this trade, I gave this an opportunity to grow and not just have a really tight stop that as soon as it starts moving a little bit in my favor, I panic and I put it right at my entry because I don't want to lose any money. It's the common thinking, but I'd rather take a $0 trade and see this thing grow to 2 times the ATR, or 3 times the ATR, or 4 times the ATR. It doesn't, I mean, I wouldn't hold it for that long, but the idea is to say once you made a profit target, place the stop on that remainder contract equal to the profit you just made, and give this a chance to work. Okay. Okay, there's going to be a signal here. I see some questions here. There's going to be a signal. And let me just change this here to... All right, so there's a pullback trade. I'm just going to do this here. Okay, to go short at 1952/4. Remember what the pattern was, guys? 2 or more bars consecutively pulling back, followed by the first red candle, this one here. That is the short entry. Is everybody clear on that? Usually I like to use 1952/4. the closing price of that red bar, a 4-tick profit. A stop here should be actually a little bit higher. And so I saw this pattern appearing as it was happening, or prior to it occurring. I just needed proof that this red candle here would plot. I like minute charts. I specifically like the 5-minute or 15-minute, Roberto, because if you look here, each of these are divisible by 5 minutes. So if you look here at 5 minutes being divisible by 10, or 5 minutes divisible by 15, or 5 minutes here divisible by 30, or 5 minutes here divisible by 60. So if there's a move that's going to occur, I like to see it happen within a 5-minute time frame, so I can understand there's something happening. Most traders aren't trading a 12-minute chart. They're trading, let's say, a 60-minute chart, or a 30-minute chart, or a 15, or a 10, or a 5. It's all divisible by 5 minutes. So my favorite is a 5-minute chart, Roberto. Okay. When is the market too volatile to trade? Good question. When the ATR is too high, it has to be, Roberto, in relationship to the market you're trading. So as an example, on the E-mini S&P, if you take a look at, where is it really volatile, I say 5 points, 4.5 points, which is 20 ticks. This is where is the, in my opinion, where it's usually a short-lived move where it's too aggressive. It's too volatile. Who has realistically a 5-point stop? Nobody. This is a short-lived move. So even at 4.5, I'd say it's becoming too volatile. What's normal is probably, let's say, 2 points, 2.5, 1 3/4, probably normal. And then there's the extremes. 1 point is too slow, 4.5, 5 is too volatile. Roberto. Doug says here, on the E-mini S&P and using the Atlas line, about how many trades come up on a regular day from open until noon? Well, you're going to get one, Doug. You're welcome, by the way, Roberto. You're going to get one regardless. At least one, because as soon as the Atlas line plots, it's 2 consecutive candles below or above that trigger the entry. So it's really based off of price regardless. So you're going to get one regardless every morning on any market. After that, Doug, if there's a pullback, if there's a strength trade, then we start looking at additional trades or bounce trades, additional trades to go long or to go short when these patterns provide themselves. Now, is it possible just to have one trade every day? Yes, absolutely. Is it possible to have 20 trades? Yes. I would say to you, 2 to 3 trades is normal on the Atlas line per market. I would say that is more normal than having just 10 or having just 1. Okay? You got it, Doug. Now, even though you can put this Atlas line to 1-minute chart or 3-minute chart, you can put it in every time frame you want. The question I think earlier, why do you only use a minute chart? I think the minute chart, or I should say the 5-minute chart, is a good balance. The other time frame that I like is 15 minutes. But the 15-minute time frame, as you know, it takes a little bit longer for anything to happen, to set up. Okay, guys. What do you think? Pullback? Pattern explained. Started. I see it continuing. Proof. Take the trade. My stop isn't 1 point. It can't be because look at that. That's 3.5 points or 3.75 of a point. How am I ever going to have a stop that's 1 point under those kind of conditions? Anybody take this trade with me? Hey, Kamal. All right, excellent. Well, I'm glad to see you guys are trust me enough that you're able to take this trade, so that's good. Excellent, good. Now, like I said, should we trade 24 hours a day? No, I think we should just pick and choose the trades that make the most amount of sense. Wait for the trade, um, see it setting up, understand what you're seeing. J 1946, possibly, right? Possibly going to hit. J, it's always a possibility. Gold, Della, for the gold market, email me at support@DayTradeToWin.com, and I'll send you some gold charts, okay? I'll be happy to show you. Cheryl says here, why do I only take 4 ticks on the trade? Definitely, I could take more, Cheryl, without a doubt, because the ATR is so high. But both pullback and strength trades, you're just taking a snippet of the market. And so I only take 4 ticks on pullback and strength trades. It should have been more because the ATR is higher. But normally, the pullback and strength trade is 1.5, 2 on the ATR. I'm being a little bit more conservative. I'm just taking 4 ticks. I recommend 4 ticks on the pullback and strength trade. But again, the ATR is this high. There's nothing wrong with taking a little bit more than 4 ticks. But I'm just being conservative. Cheryl, it's only the double bar short or double bar long because those are the start of a move, the start of a trade, or the start of a trend, or the start of something is where I want to take the full ATR. Cheryl. I would say, Tom, experience has a lot to do with it. But I think that being objective is more important because, I teach a lot of people the Atlas line, and there's a lot of people signed up for the mentorship program. And the reason why they come to me is because I never say it looks like, or it could be, or maybe. I try to avoid words like that. I want to say, prior to the move, do I see it setting up? Where's my entry? Where's my stop? How am I going to manage this trade? I want to have everything laid out for me as I move forward instead of, okay, let's go in because it looks like it's turning around. And that's not the way to trade. The way to trade is saying, okay, what is a pullback? This is a pullback. What is the entry or the trigger? First red candle that tells me we're on our way back down, period. Then we manage it. Pivotal stop, time-based stop, what's my target? That to me, and why people come to me, is more important than shooting from the hip. Tom, if that makes sense. You're welcome, Cheryl. And if anybody wants to email me privately with any questions that you have or questions on any of the programs I have, I see a lot of emails coming through here, but I can't answer them, so I'll answer them when I can later today. About the mentorship program, feel free. If you want to call us, you can call us as well. 888. Someone here will be happy to answer any questions you may have. Michael says here, is the ATR ticks or points? The ATR in this market, the E-mini S&P, is configured in points. So when I see here 3.97, it's 3.97 points, or 3 points, or 2 points, or 1 point. The ATR on currencies, so for example, here is the euro, right, with the Atlas line. Let me just expand this here. You see here it's 0.0000842. So the way that the ATR configures markets is different. So in the currencies, the way that you would understand what does this mean, how do I know how much profit to take, or what are the current conditions, 0.000842, right, is going to be 8 ticks because we move the decimal place over 4 places to the right. Okay, so in currencies it's listed in ticks. On the E-mini it's listed in points. As a trader you should be versatile in saying ticks, points, if you're a Forex trader, pips, right? But they're interchangeable. It's just how the average true range indicator that I have on my chart, how it calculates it. Okay? Michael. ATO part 2. Short, right? Here. Put on the. I have at the open method is the flagship method that started off that I started teaching everyone, the at the open method. I have it now. I don't sell it separately anymore. I offer it. It's the first week of the mentorship program. So I have the software here for the at the open software, at the open course. It's all included, but I'll show here the ATO. The ATO here is, here, I'll remove the Atlas line from the chart, and I'll remove here everything. Here is the ATO software, which Nate is referring to, because Nate has it, and just make it a little bit clear here. So the at the open method had a short here. If you were unable to take it, the ATO short is there. Right there. This is the short setup on the at the open method. 1955. Thanks, Nate. I wanted to focus on the Atlas line and other methods too, so thanks for bringing that up. You're in a parking lot. That's kind of funny. All right, Sam. Okay. So let me take this off here. Put back the Atlas line. I know some of you have the at the open from back from 2009. Okay. Now, what I see here, just so you know, I see a strength trade, and you're going to see the S's pop up in about a minute. Those of you who have the Atlas line know, because I taught you this already, but here we have strength appearing. If this candle stays red, which is lower close and open, short. You got it, Jay. Good job. ER, it's not auto tradable, meaning you turn it on and it, buys and sells for you as you are making coffee. It doesn't work that way. It provides you the signals. You still have to place the stops and the targets manually based off of the current conditions, and I think that it's important for you to monitor what you're doing. So it's not a fully auto tradable system. It is added to your chart. It provides you the signals. You then have to monitor it with both the target and the stops. Usually 4 to 5 candles, which is about 20-25 minutes is the max you're in the trade. Okay, so here's the S's for the strength trade. Strength trade is 1947. 1947 is this strength trade here. I'm not going to take this trade. I'm going to pass on it. But this is the strength trade at 1947. You got it, Jay. Email me if you have any questions, okay? The software provides you the signals, and it provides you the pullback and strength trades, provides everything for you. Yeah, Joe, the ATR was pretty high. The pullback and strength trades are more conservative. They're just 4 ticks, 1 point on the E-mini S&P. So 1947, 1946 is the 4 ticks. But you could have taken more if the ATR is pretty high. No doubt about that. Sam, what's manual? Are you referring to the ATO or the Atlas line? Sure, Sam. You can go ahead and visit DayTradeToWin.com and click on the software tab, and you can find the Atlas line there for a 6-month or for a lifetime license. I think that there's a lot of auto traders that don't take into account news, that don't take into account slow activity, Robert. And I think that as a trader, if you're just going to trade for 2 or 3 hours a day, that's all I like to do from the morning until noon Eastern Standard, which is 2.5 hours. That's all I like to trade because this is where the action is. And I rather do it myself than let a robot do it for me, which a lot of things could happen under those conditions. You know, Art, I don't use pivots. The Atlas line has nothing to do with pivots. Okay, so no, there's no pivots. The only kind of pivot that I use is what's called a pivotal stop, and I teach this pivotal stop in class where if you see, and we'll take this pullback trade here for a moment. You see how the market went up and then returned back down, right? So we don't know the future. So we have to act as if we don't know the future. But I use pivots, not daily pivots or weekly pivots. I don't use any of that stuff. Or Fibonacci's or moving averages or MACD or bands. Those are things that I do not teach. I only focus on manipulation. I teach a method called the roadmap that is an old school method of manipulation that still exists today that, believe it or not, traders don't know about or don't understand it. And it's all included in the program with software as well. But think about this as a pivot unto itself. The market retraces, I understand it. The market's continuing back down. Think of this here as a pivot that you have to be wary of. You don't want to see the market just go straight up and take that out. You want to see the market continue. That is the only reason why I would use that as I call it a pivotal stop. I teach that as a pivotal stop. And if this market is continuing back down, it shouldn't go back up. It definitely should not break that pivot. And this is, I forgot who asked that question. Art asked that question. John, is it realistic to only do the ES market and be successful without having to worry about other markets? I only like the E-mini S&P because I'm very good at it. There are certain characteristics of the E-mini S&P, especially when it comes to manipulation, that I can count on. And for me, it's just the E-mini S&P. I can trade it very well, and I like it. Slippage, I like limit orders, Della. So the orders that you've seen me place today are all limit orders. They are not, excuse me, they are not market orders. So I prefer limit orders. I know that sometimes limit orders you can't get filled because this morning here, for example, it ran away here, this 1945. And had I held it, sure, I would have gotten filled here and it still would have been successful. But I like limit orders. I want exact prices, Della. A question here from Cheryl. Why am I passing on that strength trade? Right, Cheryl? Okay. I have to be realistic. So even though these signals here are clear, it's a strength trade, it's a pullback trade, it's a double bar short, double bar long. Another aspect of it is, am I entering as the last guy arriving at this party? And if you enter closer to the Atlas line, better the trade. You're getting in at the start of the move. If you're entering in closer to this pivotal stop, the better the trade. In this example, look how far away, Cheryl, I'm entering. 1947 is the entry for this strength trade. The pivot, or where the move started, was 1954. It's not always like this, but the market is a little bit heavy today on the volume, and the range of these candles are huge. So if you think about the risk, you have to ask yourself, is it worth me taking a trade for 4 ticks where it could potentially move this distance from where it started? So I don't want to be the last guy jumping in, overbought, oversold, overexhausted. It's moved a big move already, a big distance. And I personally don't think that it's smart to trade here based off this pattern, only to hope that it's going to continue further down. If I was going to get into this trade, it would have been closer and then taking it down. That's the reason why I pass on this strength trade, or I passed on this strength trade for that reason. The pullback trade, much closer. I have less here to risk if this trade did not work in my favor. Cheryl, let me know if that makes sense to you, if I explained that correctly. Doug, the programs that I offer that teach market manipulation are in the mentorship program. They're the roadmap, they're the X5 trade. Those are the ones that I teach that are part of the mentorship program that base everything on manipulation. Charlie, 10 to 15 is my comfort level. I notice that if I go over 20, my fills are harder to achieve. The fills are, I get partial fills, Charlie. So 10 to 15, I find very comfortable. During the Fed, ER? You got it, Charlie. It was successful, Nate. And because it's all based on price action here. It's not, it's Chase the Trade, Nate, Ron. So you have the At the Open course, right? The ATO2 that is that Nate was referring to, he was referring to Chase the Trade, right? Which is almost like a part 2. If you don't get filled on the ATO, you have kind of like another option, Chase the Trade, right? Excellent. You know, Alex, I offer training, live training. I have to set you up. So I can't offer any type of free trials at this time because there's a lot involved with getting you set up, making sure that you understand the method and also the support that's involved. It depends the type of large move, Tom. Remember, the closer you are to entering, as soon as the market opens, the closer you are to the outline, the better the trade. So the big move could happen after the fact, or the big move could look something like this, where you have one candle that's really strong and then another candle that retraces back. You could still consider that a big move, but you're entering here as opposed to entering way up here. Tom. Or the power price action, John. The power price action, John, or the mentorship program, which is all inclusive, would be a great beginner, because the power price action, you meet with me for 8 weeks once a week, and we just focus on the blueprint, on the power price action trades only. So if anything, I would say to you, the Power Price Action DVD course because it comes with the 8 weeks of live training. Excellent. Okay, so what do we cover today? And this may be another strength trade here setting up in about 3 minutes or so, 3.5 minutes. So what did we learn today? We learned trailing stops. Anybody have any questions on the trailing stops? How I trail a stop by multiple contracts? Okay. We learned a little bit about the Atlas line with these trades. Some of you took it. Some of you watching. I don't blame you. The market's volatile. Um, Pullbacks trades, strength trades, Atlas line trades. We looked at a few markets. We talked about the ATR, the average true range. Here is the Nasdaq as well. So here's the pullback trades, the strength trades on the Nasdaq. I know some traders always ask for the Nasdaq. Those of you who want the gold chart, email me and I'll send you some charts on gold. Pivotal stops, time-based stops, prove-it stops. See what you're seeing here, because this candle may not close, lower close and open, we may not have a strength trade. And so I know the patterns ahead of time. And so I'm going to focus on waiting until it's very clear before going short. And the other thing is you always want to consider this is the start of this move now heading back down. So the risk, that's for Charlie who asked that question, is less as opposed to this strength trade, which after it makes a big move down, you don't want to be the last guy here going short at the end of the party. Here is the start of a move, again to the downside, and the risk is less. Makes more sense. The risk to reward, Roberto, I like to use a management of stops that protect me. When you first enter into the trade, your risk compared to your reward has to be equal or larger. Because if your risk is smaller than what the current conditions are, you're going to just get whipsawed out of that trade. So I'm not using just one stop of risk to manage the trade. I'm using a combination. So for example, you first enter the trade, you have to have a protective stop. I call it a catastrophic stop. The catastrophic stop tells me I'm entering and I want to see this trade successful, but if my stop is too small, I'm going to get knocked out. So the catastrophic stop is there as a last case, almost like an emergency case, Roberto. As now the market moves forward in time, let's say it's not going in your favor. Let's say you're losing a little or you're maybe making a little. At that point, we manage it with time or with proof to get you out with a smaller risk. So when you first enter, you got to have a stop that keeps you, that's large enough to keep you in the trade based off of the current conditions. I call it a catastrophic stop. Has to be larger than the current conditions. I use the target as the current conditions, so the risk has to be larger than that. But it's not the only. I don't wait for the target or that catastrophic stop to be hit. I use that catastrophic stop as an emergency in case I need it. Because if I enter long and there's a terrorist attack in the world, the market's going to tank. And if I don't have that catastrophic stop in place, it's going to go against me very hard. So it's there for a catastrophe for that reason. All right, strength trade here, 1946. 1946. I'll wait till it comes down to 1946, or maybe I can even get in at a better price. Why not? And my stop is 1948.75, 49 quarter. There. Okay. Roberto, going back to Roberto's question. Is that clear on that? Excellent, Charlie. So you have to think of it in those terms. I You have to think of it in those terms. A one-stop shop or one stop for everything, and then you're just going to wait until it gets hit. I don't like to do it that way. I like to have it in case I need it, manage it using other things. Okay. Completely different, Cheryl. Trade Scalper is three tick target, in and out all day long. Works. It's price action based. It works on multiple markets. Comes with software. The Trade Scalper is very popular. A lot of people like this Trade Scalper, and it's you can do it manually, but the software does it all for you. Gives you the entries. There's two different setups on that. It comes with a bonus, the X5 or the Floor Trader Secrets Guide as a bonus. Yes, I explain Perminder all of these trades, how they work, why they work, to anticipate them. You learn it all. That's absolutely correct. Kevin, is there a link for the bar timer correction? Oh, that's right. Hold on a second. Thanks for reminding me. Let me just take a look here. Um, we'll go on. We'll only count down. Okay, so let me see here. Hey, Chad, do I have a blog link that I can give them in the room for that? I know that you Skype me, but did we do a blog on that bar timer? Yeah, please do. Give it to me, please. All right. Thanks for reminding me. I'm gonna get that link for you, for those of you who are asking about the bar timer. Thanks for reminding me. You got it. This is actually, I don't know if I can. All right, so this trade is not going to work, and maybe not. Let's see. Right, my stop is there. All right, you got it. Joey, yes, but if you get hit with a 16 tick stop plus commission when only taking 4 ticks profit, 80% will not be enough. You're right, Joe. So these trades have to be high probability. They have to be high probability trades, Joe. They definitely do. Thank you, Chad. So let me copy that. Let me give this to Kevin. So you can have that link. All right, there you go. All right, guys, it's 11 o'clock. I have a class starting here. Um, for those of you who took this, good. This pullback was good. This strength trade was good. I didn't take it. And this strength trade here did not work. You got it subbed out. So all in all, not a bad day. Market may do one of these reversals during the day and come roaring back up as it's done last couple of days, but it's only a maybe. We have to wait until it crosses the Atlas line. For those of you who have the Atlas line, later on in the day, you can see if that happens. You can take advantage of that. And if you have any questions, feel free to email me, support@DayTradeToWin.com, or you can call me directly. Some of you signed up for the mentorship program. We're going to start on Monday next week. I may extend that starting it the following week, because a lot of traders asked me to extend that because it's Columbus Day. It's a holiday, so I may change that a couple of days out for the start of that program. All right, good. I'm happy you guys enjoyed it, Ann, and hopefully I'll talk to you guys soon. I'll try to do more of these too. I know you guys enjoy it, and time is a commodity unto itself. So I will try to do more of these webinars where you guys get to watch, learn, ask me questions. I think it's important. Take care, everybody. You got it, guys. Bye bye now. Hopefully you enjoyed this presentation of live trading with DayTradeToWin.com. Remember, all licenses, software, and courses are included in one package with the mentorship program. Join up. There's still time. October 20th, 2014. A new class starts for the next 8 weeks, 2 months. Until next time, have a great day.